Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session. We've got lots to cover. Market seems to be moving down. Volatility is starting to creep up to the upside. I think it's a trap. We'll see, but we'll talk more about that as we get into today's call. Before I get too far into the call today, and actually before we even get into the trades, we're going to be covering some different things that I think that we need to do. And a matter of fact, I think we need to do it on a monthly basis. And so for about the first 15 or 20 minutes, we're going to take some time to do that today. So before we get started, just an update on the Trade Partner. If you're familiar with Trade Partner, of course, that's the platform that I use and most of you use as well for all of these types of strategies and trades. You will be able to own stock in Trade Partner if you want. If you only want to buy $100, you can buy $100 worth of Trade Partner and be a part owner of the platform that you're using. New laws allow this to happen. Those laws take effect on March 15th, and so we cannot officially offer it until March 15th, but that's the launch date, and there'll be more information on that on March 15th. So that's coming up really close. I know a lot of you are excited about that. So the first 15 minutes of what we're going to be talking about today, maybe even 20 minutes, we'll see, is we're going to kind of go back to the basics. And I want to do this about once a month. It's kind of go back to the basics. I know a lot of traders come in, and I tend to get to the point where I'm assuming you've been in the calls for 6 months or 3 months or whatever, and I tend to skip over some stuff in these calls. And of course, the calls are not meant to be a single call, and I'll talk a little bit about that. But we're going to talk about going back to the basics today, because it is very, very important that you approach all of these different strategies and nuances for how we take advantage of SPY from the proper foundation. So that's going to be today. And I'm going to also give you a schedule of the March calls. We're gonna make these more theme based, and so I've created a schedule, and I'll share that with you as well. So for those that are new on the call, I do want to welcome you. We have a lot of new folks on the call today, and I want to welcome you, but I also want to warn you in advance, even though we're going back to the basics today, I don't explain everything about these trades on a single call. It's impossible for me to do so. There is so much information. If you're going to learn how to properly trade SPY spread options, which you absolutely should do, as you're about to find out, you need to learn everything you can about it. And so that's why I have these calls twice a week, every week. I should say most weeks. Okay, so these calls are not meant to be one-offs. These are meant to be cumulative. You should attend several months of these calls before you decide that you're not going to approach or utilize the approaches that we talk about in the call. I also want to warn you that these trades are fantastic. You're going to see some fantastic trades today, but however fantastic they are not the Holy Grail. Therefore, you have to start small. There is some complexity. Some has more complexity than others, but you don't want to start big. You don't want to see these trades and get dollar signs in your eyes and say, oh, I've got a $100,000 account. I'm going to do 25 of these things. No, don't do that. That's a big mistake. People in this call right now have been in here for 6 months, 8 months, however long they've been in. They'll tell you they've done the same thing and they didn't listen to me, and they should have. So don't do that. Start small. Don't be reckless in how you throw these things together, and make sure you follow instructions. And one of the instructions that I strongly suggest that you follow, in addition to starting small, is that you take your time before you actually make your first trade, and really commit yourself to understanding that particular trade, and then that will help tremendously. So why do we do this? SPY options are not the easiest thing in the world, but they're not that difficult once you have enough exposure to them. And once you understand the principles of how they work, but the reason that it's worth it is if it takes you 2 months, 3 months, 6 months, the reason that it's worth it is because of the compounding effect. With most of the strategies that we talk about, you are able to compound very efficiently, and some more than others, but in some of the more efficient compounding strategies, if you can just average $10 a week, that's it. If you can net just $10 a week, you're talking about turning $1,000 account into 35,000 in 5 years. Okay, obviously you have to trade one of the lower risk strategies to do that, or you can put it in here as 5,000 into 35,000 in 5 years. All you have to do is average $10 a week, or $20 a week grows into 135,000 in 5 years, and $30 a week grows to 304,000. So our goal with these trades is not to make a killing every week. It's not to slay the S&P. It's not to have these huge bragging rights about this massive trade that we put on. That's not it. That's for newbies. That's for those who really aren't interested in true growth in the account. True growth comes because of the compounding. Period. End of story. And if people are not focused on that first and foremost, they're wasting a lot of money. I don't know how else to be more plain with that. So the first goal with everybody, and this is a basic tenet, this is going back to the basics. The first goal that you should have is not to make $100 a week, although that's a great goal to have down the road, because $100 a week grows 5,000. You're not going to be able to do $100 a week on $1,000 account. It's going to be closer to 3, 4, 5,000 that you're going to need to trade in a manner that will do that. But if you can do $100 a week, if you can get to that level, the compounding is just astronomical at that point. So it is well worth it to understand and learn this, because you're not having to learn this rocket science type approach. You're only trying to get to the point where you can average $10, $20, $30, $40 a week, and then slowly improve that weekly average once you reach each goal. That's where you should start. If you start anywhere else, if you start, I'm gonna make $400 this week, whatever the case is, you've got the wrong mentality, because that's not it. All right. So this is the exact compounding plan. And this one has a starting account size of 2,500. And really, it doesn't matter as long as you can. What I generally say is, listen, whatever strategy that you're trading, you need to be able to suffer 3 or 4 max losses in a row based on this approach, right? 3 or 4 max losses in a row minimum, and continue trading. Because realizing a max loss in these twice in a row is highly, highly unlikely. So that's kind of where I talk about the starting account size, but definitely give yourself enough cushion so that you're not feeling the pressure if you do suffer, come out of the gate and suffer a loss or whatever the case is. Okay. So in just 6 months, if once you get to the point where you can average $100 a week, you're talking about growing a small account by about $30,000 in just 6 months. So the compounding can and will take place eventually, as long as you're able to average the small amount of money that is the goal every week. And you can see here, this is the 5 years. This is extending this exact same compounding plan out to 5 years, and you can see where I came up with the 3 million. This is math, by the way. It's not exact, because there are times where you will decrease contracts or decrease trade size, but it's going to be really, really close. If you average $100 a week, you're going to be really close to that number. So that's the goal. That's what we're here for. I want to make sure that everybody is absolutely in line with that 100%. Okay, now triple play options is all about volatility. In fact, we've divided our strategies based on volatility. So when volatility is low, in SPY, there are certain strategies that work better. When volatility is high in SPY, there are certain strategies that work better. And when volatility is going through a transitional stage, then there are certain strategies that work better. Right now, we are in the middle of going through a transitional stage at this point. Whether we go back into low volatility depends on one thing. And if you've been in this call, you know what that one thing is. What is the one thing? That's right, price moving up. If price moves back up, volatility will exit these options very, very quickly. Okay. And one of the complaints that I get is why are we learning this strategy? And why are we learning this strategy? And why are we learning this strategy? Well, why can't we just have one strategy that fits all? And believe you me, I wish we could do that. I would absolutely do that if it were possible, but it's not possible. And anyone who tells you otherwise, it just simply doesn't understand what they're talking about. So the first thing you need to understand is how volatility affects option prices in SPY differently than individual stocks. And when I say SPY, I mean SPY, QQQ, IWM. So stock index markets. And here's how it works. As stocks move up, volatility or option prices move down. Okay, as stocks move up, as the index moves up, volatility or time value in the option prices, and specifically in calls mainly, that moves down. Okay, as stocks move down, as they have been over the last several days, volatility or option prices or time value moves up. And of course, that is something that is going to be relative. I'll talk about that here in a second. So you need to ingrain this into your head because it does matter. Stock market indexes move down, intrinsic value increases. Stock market indexes move up, extrinsic value decreases. That's how it works. It does not work that way in individual stocks. This is only for S&P, which is why the volatility number is so deceiving in SPY. Because they don't have a math calculation within that reflects this absolute truth. It's been true for as long as I've been watching SPY. And so I'm going to give you an example. This was several years ago, and I could show you how this was true in a matter of 10 minutes. Right. So here is a 287 call that's at the money. And then 288 calls at the money. So if the market is trading at 287, that's lower than 288, right? Yeah, pretty easy. Well, that 287 call is actually going to be worth more than the 288 call if the market moves up to 288. And I mean, it could do it in 5 minutes, 10 minutes, and that is going to be true most of the time. Okay, so in fact, I gave an example here. At 1:35 p.m., SPY was trading at 284. Okay. And the at the money call at the time was 250. So again, this was a couple of years ago. But you can do it right now if you want. You can mark the at the money call and look at it, and you're going to see this. You're going to see this work out. So at 1:35 p.m., market was trading at 284. The at the money call is at 250. 10 minutes later, the market had moved down. Okay. We're further past in time, right? More time has passed, but the at the money call was trading at 270. And that's simply because as the market moves down, volatility moves up. And if the market moved up back up to 284, the at the money call would be trading at something less than 270. It is almost guaranteed. And you just have to understand that. And also you need to understand that stock index markets stabilize. Then the extrinsic value decreases. Okay, so once the move happens, then things pause, if you will, and then the extrinsic value goes out. And again, this is relative. If SPY is trading at 285 on Monday this week and prices don't go anywhere for a week, then the 5-day at the money option next week is going to be cheaper than it is this week. That's the way it works. So it can happen in 10 minutes. You can extrapolate that out to 5 days away, a week away, 2 weeks away. However it is you want to do it, it's a truth that is out there, and it's not going anywhere. Okay, so the greatest amount of extrinsic value, though, when it is increasing, occurs at the time of the move. So as the market is moving down, that's when the extrinsic value is increasing in the options. Once it pauses, then it immediately begins to drop out, and the relative price action remains the same. Right. So this is why you cannot have a one strategy fits all, because different option prices in various conditions mean that you cannot always get the same price for a spread. And if you can't get the right price for a spread, then the correct action is to pass on it, not to get it at a worse spread, unless you know how the volatility is going to affect the end result of that trade, which is one of the reasons why I went through that again, as a basic reminder. This is also why you need to learn and understand the option patterns and strategies I trade in these live trade sessions, because what works this week may not work next week in the same manner because of pricing, because of volatility. And that's one of the reasons why we have these calls twice a week, so that we can so you can watch how the different conditions in SPY affects the different strategies and different patterns and different trades. All right. So again, all you need is $20 a week. That's worth learning these strategies and sticking with these strategies. And if you can do that, I can all but guarantee that over the next 5 years, you'll be any other approach that you might be trading or considering right now. So again, one of the keys to this is commitment. Bottom line, that's going back to the basics. You have to commit. And I'm going to talk about that here just a little bit more before we get into some trades. All right. So there are several strategies that we focus on. Option insanity is more for low volatility. Although if you were attending my 911 emergency live trade calls back in April of last year, March of last year, when stocks were cranking to the downside, we actually did put on an option volatility that was, or a option insanity trade that was so far out of the money, it was ridiculous. So it's not absolute, but the most opportunities exist in low volatility. Then there's the 911 emergency patterns. Now, we're not going to go over 911 emergency patterns on these calls unless SPY tanks. And then everything else gets dropped and we focus on those, because those are absolutely incredible patterns, absolutely incredible opportunities, ridiculously incredible opportunities. And some of you have been on these calls you remember some of the trades that we were taking a year ago. All right. So forget about 911 emergency, but if SPY tanks, you're going to want to be on these calls. That I will promise you want to be on these calls if SPY tanks. The next one is crazy calendars. That's one that we've been focused on over the last five-ish months, because it is more of a mid volatility, but you can also trade it in low volatility. You just have to be a little bit more careful when you're trading it in low volatility. And of course, you have to make that transition. So right now we're kind of in a transitional volatility, but if SPY moves back up into the mid to upper 80s, the volatility is going to be coming out of these options, and you have to take that into account with regard to crazy calendars. And we're going to be talking about crazy calendars today, because those are the ones that are most available right now. Then profit stacking, and the profit stacking is more of a process, as it is more of a process as opposed to a strategy. It's a process that you can almost apply to any strategy that we talk about. and it's really, really powerful. And then the risk-free calendar spreads and how to put on risk-free calendars. And that one is, it's for mid volatility and low volatility as well. It's really not as good for high volatility markets, although again, it is not one that is absolute. You can actually put on some risk-free calendar spreads in high volatility markets as well. All right. So, given those basic approaches that we discuss, one thing that I've done is I've created the March calendar so that we focus on these various aspects and make sure that we pay attention to these various trades and strategies on some level, so that if there's one that you really want to learn more about and want to focus more on, then you can make sure that you attend that particular one, and obviously ask any questions that you might have. That does not mean that we're not going to cover more on the calls. It just simply means that the focus of the call is going to be more on one aspect as opposed to a different aspect. So, of course, last Monday we did crazy calendars. Today we're going to be back to the basics, and part of that is kind of a broad brush stroke, if you will. Monday we're going to be talking about the risk-free calendar core trades. And we're going to be focusing on that because there are different ways to put on the core trade to start the process of creating risk-free calendar trades. The comparison exit principles will be discussed on the 11th. Profit stacking is going to be focused on March 15th. Crazy calendars again on March 18th. Option insanity on March 22nd, unless the market is in a high volatility area, at which point, again, we will defer to 911. On Thursday, March 25th, it's going to be trader determined. So I'm going to take a vote, and y'all are going to be able to vote on what it is you want to focus on for one day out of the month. And then, on March 29th, we're going to focus on bullish patterns, then bearish patterns, and then neutral patterns. And again, we're not going to be ignoring the other strategies or trades. If we're in a trade, we're going to be discussing those trades. So, for example, today, I'm going to talk about this option insanity trade really quickly. I'm not going to spend a lot of time on it, but just as an update. Many of you know I have an option insanity trade. It's called a 5-1 option insanity. It's where I'm actually selling 5 and buying 1. And this looks like it's naked 5, but actually what we do is we put on margin hedges, and the margin hedges is simply 5 longs that are way out of the money, and so we're barely paying anything for them, and it's the only reason that they're there is just simply to reduce the margin on these trades. This particular strategy, option insanity, is the one strategy that you cannot compound efficiently. But what you can do is you can use profits from option insanity and use it to help compound the other strategies. So there is a function, and it's a great strategy in and of itself. So this is the trade that I had on 5-1 option insanity for a $450 credit. And this one, I added a second long. So instead of having just a 394 long, I actually added another one as the market moved down, and my credit went from about 450 to about 220-ish. And so I still have a $220 credit, and right now that's about where that market is at, or where that trade is at. And I'm making about $220 on the trade. We are way down here. The profit bubble is way up here, and there's no reason for me to get out of this trade. I'm going to stick with it, and that's basically it. If the market moves up, it's going to move up, and I'm going to have the potential to get out at a much better profit, potentially much bigger profit. long before it ever reaches the risk level. And that's one of the principles that I really like to implement, whether it's option insanity, whether it's crazy calendars, or any other strategy. I like the possibility of the market moving through a profit zone and giving me the ability to exit at a profit before it ever reaches the risk zone. And it doesn't always work out that way, but the further out of the money you go, the more often that you have that opportunity, the higher the probability the trade is. So here's the option insanity after I added the second long. Okay, about a $220 credit. You can see here a massive profit bubble that peaks out at about 400. And this does not end until the week of ex-dividend, right? So this is 2 weeks out right now. So we have 2 weeks for the market to move back up and potentially in the profit zone. If it doesn't move back up, fine. I'll collect my $220 in credit and be happy. So I'm at least in a position where if the market does move back up, I've got the potential to get out at a significant gain on this trade with almost no risk. Then the one trade that we talked about, putting on a risk-free calendar, removing part of the risk-free calendar. This was the trade that we exited, and again, the market moved down, and so all I was able to do was pull in the credit on this one. This is what we'll be covering. When was risk-free calendars? So yeah, that'll be Monday actually. So we'll cover this in more depth on Monday because they are available right now, and this is a risk-free calendar that we have working on tomorrow, or that we had working for tomorrow. This was a 397 short, 401 short, and then the longs were 402s. We then added a long 401 at 93, so we were filled at the core trade is what order number 1 is. That's the core trade. We were filled at a credit of 108, and then we added a 401 at 93 cents, creating a risk-free calendar within that core trade, and an overall credit of $15, and that one is basically done. I mean, there's just no way that we're going to do anything more on that trade. I don't care what happens tomorrow. We're basically going to make the minimum credit, and that's it. And sometimes that happens, and you just go on to the next trade, right? But we're going to make $15. If your first goal is 10, not a bad start, even though it's only 15. And you do have to understand that when you talk about averaging 10, you're talking about averaging the losses in there as well, right? So you don't take a profit target of 10 on every trade, because eventually you're going to lose money, and then that's going to drive you're going to lose on a trade, and that's going to drive your average down. So just want to throw that in there real quick, okay? And so then we talked a little bit about crazy calendars on Monday. We focused on those. I want to talk about those a little bit more today because the market is moving down and there are some opportunities in crazy calendars. So we're going to explore those a little bit more. But before I do that, I think it's always good to hear from the subscribers on strategy specifics. And a lot of you have provided comments on what you're trading, what you focus on, and what you've been able to do. And so this is from one of our subscribers here. John, if you're on the call today, I appreciate that comment. I appreciate any comments. I love hearing from the users who come in here and they stick with it and they learn how to do it, and then they're successful. And so John's been with me for about 5 years, and he thinks that the crazy calendars is the best strategy that I have presented. And I don't agree with him, but we all have our favorites, right? But he's been able to use that. So, that's just some encouragement that if you're new and it seems a little overwhelming, just stick with it. That's the key. All right. So what do we want to do with crazy calendars? Well, what are crazy calendars is basically buying cheap buy. How you like that? That's there. Buy cheap calendar spreads. Buy cheap calendar spreads, and then we find a way to pay for them. And the key is to go out of the money. But we find a way to pay for them because calendar spreads in and of themselves are not great investments at all. I would never, ever just trade calendar spreads and not do anything else. So we combine calendar spreads and we group calendar spreads with a way to pay for them. And that creates a much higher probability scenario. And so there are several different ways that we talked about. And one was using a diagonal spread, one was a credit spread, one was a TPO bearish spread, and then you can just sell a call. And that's actually one of my favorite ways to do it, but it's also the requires the most margin, and it's the least efficient of all of these four as far as compounding is concerned. So everything has their pros and cons and drawbacks and things that you like about it. So here's a crazy calendar that we placed on. This was not filled on the call Monday, but it was filled after. And of course, the market was moving down, and so this is pretty much not going to be worth anything. This is, of course, for next week. It's not this week. It's a crazy calendar that ends next week. And we used a diagonal, and the diagonal was a 397 short. That was short 312, so that's next Friday. And then the long was the following Monday, and it was a 402. So it was a 5-point diagonal. And then we bought 4 calendar spreads, 312, 315, that's 400, 400 strike. And this is what it creates. Of course, this is absolutely irrelevant at this point because the market's not going to move up. Well, I shouldn't say that. I've eaten my hat before in this group because I've said that once and the market did, in fact, move up. So I won't say it's absolutely won't move up, but the likelihood of this moving up into the profit zone is very, very small. So this is just one that we're going to hang on to at this point and see what happens. And if the market happens to bounce, then we might have a potential profit. Of course, there is no risk to the downside on this one because it was at I think I got filled at a credit of 1 cent. And I specifically created this trade because I felt like the market was going to move higher. And of course, on Monday was the first calendar day. And again, if you're new, one of the things I've talked about for many, many years is the first calendar day is bullish in stocks, in SPY specifically. And I said that last Thursday, and of course, Monday was the first calendar day. It was the largest single up day in I think like 6 months or so, something like that. So we were trading up here, right? 388, 389, somewhere around there when I put this on. And of course, the market went in the other direction instead of moving into the profit zone. And so we're just going to sit on this particular trade. Now, this poses an interesting scenario because if I wanted to, I could create another one that has a profit zone somewhere around 390, 392. And at that point, if the market screams to the upside, if I'm wrong about the market, moving up into this profit zone for next week, and the market screams to the upside, then when my second trade begins to lose, I'll actually be making money on this particular trade. So that's, you absolutely can combine these like that. And when the market moves down like that, I did not create a credit. I normally almost always try and create a credit, at least about a $20 credit on these, just in case the market tanks. And on this one, I just wasn't comfortable with 3 calendars. I wanted to do 4 calendars instead of 3 calendars, because the first week of March in general is bullish from a seasonal standpoint. So we got our first bullish day of the first calendar day of the week. That was bullish, and then nothing else. We haven't seen any more bullishness. It's gone the other way. So that particular seasonal hasn't quite worked out as far as the first week. But notice I did not try and pick a direction with this thing. Yes, I did lean towards a more bullish direction, but I didn't commit to that by creating a debit on this trade. I almost never create debits. I don't like creating debits. I don't like losing on these spreads if the market moves down, because the market has a more of a tendency to move down quickly than it does to move up quickly. And so I made sure that I created credit. I'm not going to lose. And sure enough, the market did move down, and I'm not worried about it. Now, that having said that, most of the time, even if you create a debit on these trades, it's a small debit. So there's no cause for worry or concern about any of that anyway, because if you create a debit, let's say you're really bullish and you're willing to create a small debit, 25-cent debit, in order to create a monster profit zone, you can do that. And there's nothing wrong with that, as long as you understand, if the market tanks, you're going to take a small loss. It's a psychological thing with me. I don't like losing if the market moves down. So that's kind of how that works. All right, so let's take a look at what is available on the crazy calendars, because the market, the overall, I'm going to move the trade partner in here, so you can see, and of course this is the spread pattern functionality in trade partner, so that we can compare the same spread at different strikes and see what those price levels are. And eventually we're going to have the risk graphs over here to the right. So you can just scroll down and you can see the risk graphs at the same time. That might be another 3 or 4 months down the road. We'll see. There's so much the programmers are doing right now, adding stuff to trade partner. Honestly, we probably need to hire a few more programmers. We've got, the list is so long of what I want to see put into place. Nonetheless, this is a crazy calendar. This is for next week, and the calendars are at 389. All right, now I'm going to just kind of toggle back and forth here. I've already got this crazy calendar trade on for next week. Okay, and so if I have a crazy calendar trade with a 389 calendar, that's where the profit peak is, right? So the profit peak is at the calendars. And so if I add a 389, then I'm going to add a profit peak here. But the problem is that you'll notice with these particular types of trades, after you reach the profit peak, the decline is pretty quick. Even though it's still absolutely limited risk, et cetera, but that decline is pretty quick. So I want to make sure that if I put one on, that I'm not putting myself at a huge risk, no matter what, because I want, especially when the market is down, the highest probability of a large move to the upside is after a large move to the downside. And we saw this a couple of weeks ago when the market moved down to around 370, 371, somewhere around there. And then within like a week, it was at 390. Right, so we're kind of in the same scenario right now. Where are we trading at? We've kind of bounced. We were trading at 3. Is that correct? Let me see here. We were trading at 375-ish at the right before the call, and And so let's see here. Yeah, we're trading at 375. Still trading at 375 right now. Right. So we're kind of in that territory where a big bounce is not out of the question. We could see this thing back at 384 by the close tomorrow, 385 by the close tomorrow, and that puts us a hair away from the 389s, which is what we saw right here. Okay, so I'll pop this back over. All right, so this is 389s, and you'll also notice that this is only 3 calendars. Instead of 4. And so anytime you have the fewer calendars you have, the lower the profit peak is, the smaller the profit zone actually is. This was trading at about a 20-cent credit right before the call. I would say about 20 minutes before the call, and it's now trading at about a 4-cent credit. Okay, so we're just going to kind of scroll. Well, let me reset these actually, and generate the spread. So this one is the diagonal spread. This is a 312, 315. So the 312 is the short. That's a 390 on this top one. The 315 is a 395, and that's our long. So that creates our diagonal spread. And that's going to be, of course, at a credit. And then we have calendars here. And these particular calendars are at 393s. So this is basically creating a profit peak at 393. And you'll notice that you're not able to do this for a credit. It looks like it's going to be trading at about a debit. And part of that is because it's only a week away, and that's too far out of the money. Go to 385, 390. Here's the 388s, and it is trading at a 21-cent credit. So this puts the profit peak at 388. On this particular one, we can't quite go to 4. And we might be able to create a small, very small credit on this one. Maybe even Steven, possibly a credit of 2 cents. Here is the 89. It's going for 16 cents. And the rest did not. Here's the 394s. Okay, going for debit. So looks like this one is about the last one that's really going to create any kind of meaningful credit is this 389. So the question is, is that something you want to do? Do you want to create the profit peak at 389 and risk the market moving down? Of course, what I'm talking about is in conjunction with last week's trade. If you don't have last week's trade, or I should say Monday's trade. If you don't have Monday's trade, then I would look for something further out in time and further out of the money. And so we will switch the dates here to 319 and 322. And we already know that we're going to get credits on these because this is ex-dividend week. And we discussed ex-dividend week in more detail on last Monday, but the only risk of ex-dividend week is if one of these goes into the money, if one of my shorts goes into the money, and that's when you have to deal with that. But we're generally out of these trades. We don't wait until the last minute to get out. We're generally out of these trades by Thursday anyway. And so I'm not too concerned about ex-dividend week since that's how we normally play it anyway. I don't think I reset those. So we're going to take a look at the pricing for going out one additional week or out 1 week further out in time. And the credits are going to be quite a bit bigger. And again, it's a 5-point diagonal, and the calendars split the diagonal, basically. Okay, so that's what we're wanting to do. So here's the 388 calendar that goes out the following week, and you'll notice that that's at a $1.30 credit. And that's because the calendars are almost they're very, very small debits. And why are the calendars very, very small debits, like almost not even a debit? And it's because they treat this one I didn't change the date right. No wonder that was so big. So let's see here. We'll do that again. So now there's the calendars here. So that's not going to be $1.30, but there will be bigger credits on these because of the fact that the 388 is going to be priced more like a 389, because on Thursday after the markets close, the price of SPY is going to adjust down, and it's going to adjust down by the amount of the dividend. And then, of course, trading takes over immediately, and that could be immediately wiped out. But they price the options that way. And so this is really more priced like a 389. And so it kind of is more like a 1-point diagonal. It's closer to a 1-point diagonal than it is a calendar. But that also allows me to create a credit. Now, I will say that there is one. Actually, let's take a look at the credits first. How far can we go and still get a credit? Let's say of 20 cents. And you'll notice here, we're going further and further out of the money. And here's the 20-cent calendar. So it's a 392, 397, and then 395 calendars. So this is going to create the profit peak at 395, and we can bring in an 18, 20-cent credit, which means if SPY tanks, we're going to make $18, $20, whatever the credit is that we get. If we can get $20, then we'll make $20. And that's all we have to average. Yeah, we don't have to average anything more. So if the market eventually moves up and into the profit zone, and we're able to exit this for $50, $70, $100, all the better. But the probability is pretty decent that that we're going to stay below the profit peak of this. And I want to say it's at about 90% right now, especially when you're considering the fact that they are pricing in the ex-dividend. So this one's going way out. This is 20 points out of the money from where we're at right now, and going for a 20-cent credit. You can go further and still create small credit, and you have almost no chance of the market going into the loss zone. I mean, like really ridiculously small probability of going into the loss zone. And because of that, you have a really high probability of being able to pull out of this thing at a profit while it's going through the profit zone before it ever reaches the risk zone, right? So this is one of those things, the further out of the money you go, yes, the smaller the credit you can bring in, but the further the market has to go before it ever reaches the risk zone. And the further it has to go, the higher the probability that as it's moving up, you're going to be able to take a profit while it's in this profit zone and move on to the next trade or the next week or whatever it is that's available. All right. So I'm going to take a look at these. When the market is bullish, by the way, or when I should say that, when the market has moved down, I tend to use the diagonal spread to create the crazy calendar. And that's because if I use a credit spread, so a credit spread would simply be selling a 319, 396 and buying a 319, not a 322, 401. That would be the credit spread. I would get a bigger credit on the trade. But the risk level on those trades tends to drop off much quicker. The profit peak is not quite as big, and the risk level, this is a pretty steep drop off. Once you get to the risk level here, once you get to the profit peak, I should say, and the market moves past that, then you start to see that profit go away pretty fast. Profit potential, I should say, go away pretty fast, and then into the risk zone pretty quickly. If you use a credit spread instead of a diagonal, that actually drops off a lot faster. You still have the profit peak. It's not quite as big, but you have a bigger credit on the trade. So again, pros and cons. And what I tell traders is that you need to get to the point where you are following these trades. Let's say you put on a single trade and then you exit, and then you put on another trade and you exit, you put on another trade and you exit. Well, every one of these trades, you need to follow until the end. Even after you exit, you need to just follow it and understand the market action and how it affects the price of that spread, because there are going to be times where you get stuck in a trade and you didn't follow the pricing of the previous trade, so you're kind of not knowing what to expect. And not knowing what to expect is where the mistakes come in. It's where people they get scared, they exit the trade at a loss when they shouldn't exit the trade at a loss. They hold on to the trade when they should exit the trade, et cetera, et cetera. And so, the key is to learn one of these strategies, the one that you're going to implement, and learn it really well. And focus on it and watch it. It doesn't take very long to place these trades on, right? I can throw up a spread pattern in here and I can choose a trade and I can place that trade literally in about 2 minutes. That's not what takes time at all. I could place it and be done and not even worry about it. Again, I don't have to spend another thought about it, because one of the principles behind this is that you accept the risk of any trade that you take. If you cannot accept the risk of the trade, then you don't take it. In other words, if you get into a trade and it starts to move against you and you are showing an open position loss and it worries you, you probably shouldn't be in that trade. So if you're trying to figure out, how to get out of the trade early, if you're trying to, one of the most popular approaches in the industry are iron condors, and 98% of the time you shouldn't touch them. Most traders don't tell you that, but that's the go-to. That's one of the go-to strategies, iron condors. And the popular thing is to make adjustments, make adjustments, make adjustments, make adjustments. Well, you can make adjustments on these, no question about it. And we talk about that a little bit. It's part of the, you might even consider the profit stacking approach an adjustment model. But the adjustment is not reacting to a massive loss that you're staring down. An adjustment should never be a reaction. Iron condors, by the way, the probabilities associated with most iron condors is not that great, and so you just need to be aware of that. It's kind of a trap trade, in my opinion, for newbies and even people who've been in trading for a long time, because one trade can absolutely wipe out 9 trades, 10 trades, 12 trades, and you're trying to adjust. And on these, worst case scenario, especially when we only put the risk to the upside, on these worst case scenario, you might be in some scenarios risking $400, in some scenarios maybe $500. Absolute worst case scenario. And when you've already put the entire trade out of the money so far that you're going to have a high probability of being able to exit before it reaches the risk zone, well, it has to continue moving up an awful long way in order to reach the maximum risk. And so the maximum risk, since we've started the crazy calendars, I haven't come anywhere close to realizing a maximum risk on a trade. So it's not going to happen often. It'll be once in a blue moon. And if it does happen, it'll probably be because of a mistake, not because of the actual trade. And that's because the market has to move up so far just to reach the maximum risk level that the probability of that is like 1 or 2%. And that's without an early exit strategy, which we absolutely employ. But another reason is because these calendars, I know this risk level drops off pretty quickly, but this particular crazy calendar, if the market moves up, these calendars actually hold their value a little bit better than what the risk graph shows when they're in the money, as opposed to when they're out of the money. And so you actually, what has to happen is you have to go so far in the money that the risk the calendar spread that is in the money is now at 0, and that's way up there. So it's just not something that is realistic. And if you suffer it once, that'll be a shock. That's why I say it's almost impossible to suffer a maximum loss in these things. If you do them right 2 or 3 times in a row, it's almost a statistical impossibility, because this is for a low volatility situation. And if it's for a low volatility situation, low to mid, the market's already high, right? We're not going to be placing on these crazy calendars in the same manner that we are right now, if or necessarily, I should say, if SPY tanks and volatility increases dramatically. Is there a set of circumstances that we could do crazy calendars after the market tanks? Yeah, if we can be way, way out of the money and create a significant credit. Absolutely. And it probably is probably much better than what I'm giving up, but I don't want to commit until I don't want to say, yeah, crazy. We absolutely will be doing crazy calendars if SPY tanks. There are better trades. There are better trades when SPY tanks. So it's a matter of choice, and there's no reason why we need to risk $400 or $500. I know a lot of you are like, that might sound crazy, but there's no reason to risk $400 or $500 when SPY tanks on some of these trades. That's how good they are. $100, $200 might be about the max risk that we take when SPY tanks on some of these spreads with massive profit potential. $1,000, $1,500, in some cases $2,000 on a trade. High probability and risking only $100, $150, $200. So it's a matter of choice at that point. Better spreads are available at that point. Okay, so am I willing to get into a trade? Absolutely. I will go ahead and I'm gonna let's see here. This is 396s. I'm gonna do the 395s, and I'm gonna do that at a credit, and I'm gonna do it at 20 cents. Now, I'm going to tell you right now that for most of you, I'm going to do this for the sake of doing it during the call, but I would wait till tomorrow for a potential bounce in SPY, and then put on the crazy calendars, maybe going a little bit further out of the money or bringing in a bigger credit and increase your probability a little bit more, or bringing in a bigger credit and increasing your overall profit potential a little bit more. All right, so I have no problem doing this one regardless. 395 in 2 weeks. I'll take that trade all day long. So I'm going to go ahead and place that trade, and then we'll let's see here. We'll go ahead and take questions. All right. I will let you know if I am filled on that thing. Let's see, want to make sure that it's placed right. And there it is. Okay, so I've got it working. It's showing a mid of 18 cents. I've got it working at 20 cents. I also would consider doing 4 calendars at no credit in the same with the same trade. Okay. All right. We covered quite a bit there. I know we focused a little bit on crazy calendars, but that's because that's pretty much what's available today for the most part. Option Insanity is still available, but I'm not going to add to that trade just yet. Will this be recorded? Yes, it is recorded. You'll have access to it within about an hour or so after the session officially ends. Can you use your platform on a Mac, or do you need Windows machine? No, you can use it on a Mac. It is a it's an online app, so it's not download. You don't need to download it. What index am I using for volatility? I don't. So now the VIX will do exactly what I've basically outlined today. The VIX will drop if market indexes move up, and it'll move higher if if the indexes move down. So the volatility calculation obviously does use the VIX, but I don't look at the VIX personally. I already know I know how it's going to react. I know what's going to happen. I know how to plan for it, and that's really what you need to do. Some of these comments are sometimes funny. Other option, Sandy. You ever, I have a course that I've not redone in several years, but based on some comments every now and again, specifically, I'm going to talk to you, anonymous attendee, who didn't give the name. You should probably go through this course, and it's called Breaking Through: Overcoming Self-Destructive Trading Habits. Negativity is definitely one of them. So, all right. So, hi, Ryan. Other than option Sandy, what is your favorite strategy? Oh man, that's a great question, and it's really hard to answer because I like for some circumstances, I absolutely love pretty much all the SPY strategies, but in other circumstances, other goals, other risk tolerance levels, my hyper options and my C4 option strategies, I absolutely love. So it's just it's hard to put my finger on just one. Since you say credit spreads yield a larger credit than a diagonal, why wouldn't you always go with the credit spread to fund the diagonals? It's because of the rapid drop-off that occurs. You also have a lower probability of being able to exit as the market is moving through the profit zone if you do a credit spread. So the credit spreads I use if I think, or if I want to be more of a bearish type scenario. So like if the market moves up to 395 next week, you can bet your bottom dollar I'm going to be using credit spreads to fund my calendars to create the credit. But in this instance, I don't want to do that because I want a higher probability to be able to exit out of that trade if the market does move into the profit zone. On our season stocks webinars, you show a chart of stock versus SPY. Each horizontal bar represents a month. However, I cannot find such chart. Barry, we don't have that on season stocks yet. It's coming. I've been watching your old Time Warp series. What do you think of Time Warp bearish, Time Warp neutral compared to crazy calendars? So Time Warp bearish, Time Warp neutral, that's one aspect of this, right? So you can actually use a Time Warp bearish to pay for crazy calendars. So this is all, I don't want you to get into I don't want you to box yourself in. Right? You need to understand the concept. And when you understand the concept, you realize that there are a lot of different ways to do this. And I show you some basic ones in order to keep it simple and to show you that there are different ways of achieving the same concept. With exiting risk-free calendars, would you always exit the core at first availability of a decent profit and then let the calendars ride, hoping for a move up? Patrick, that's a great question. Not necessarily. If I think that there's a high probability that I can add a few more calendars, risk-free calendars, then I may wait for that. If I don't think that that's the case, then I'll go ahead and just exit a portion of my core trade, create a completely risk-free scenario altogether, and whatever happens, happens. Let's see. Would an in-the-money put be as at risk of being exercised on dividend week as? No. Will the pattern you called payday last time there was a dividend week be viable again? The pattern I called payday. 1 week spread between the sell and the buy. The view sell. So Philip, that was probably done before Monday, Wednesday expirations came on the board. Obviously, when Monday and Wednesday expirations come on the board, I kind of morph the strategies as the conditions also change and the opportunities change. What about commissions? You need to be with a broker that does not charge commissions. I go through TradeREC. They're the best, and they're the best because not only do they not charge commissions, but they don't hide a secret commission and call it an exchange fee. So TD Ameritrade, we are hooked up to TD Ameritrade. They do not charge commissions, but their exchange fee, quote unquote, is 60 cents. It's about 13 cents with TradeREC, so I know that they are not being forthright there. Is trade partner compatible with IB? Not yet. We are working on hooking it up to IB. On the compounding plan, add max risk for one contract of 150 on a $2,500 account. With crazy calendars and a 5-point spread, is the max risk 500 less the credit? Yes, that is correct. And I've mentioned this before, so I'm glad you have brought this up, but the max risk is more of a guideline and more of a realistic max risk, right? So I know technically my max risk is $500. And if I have a small account, I'm probably going to be a little bit more conservative on the money management, but I know the probability of me realizing a let's say $480 max risk, or in this situation, you can also decrease the spread between the diagonal from 5 points to 4 points, and that will lower your risk a little bit more. And so I know that I'm not going to suffer the max risk of, let's say, $450, $480, whatever the case is, depending on whatever trade I put on. Not going to suffer that max risk 98, 99% of the time. So I'm not going to create a compounding plan that that is limited by something that may or may not ever happen. So it's more the 150 there max risk is more for a guideline of what you are more realistically like to experience, likely to experience. I'm new and have not yet figured out how to pull up or create the risk graph. Can you give some pointers? Concerned about placing the trade without a visual first. So Mark, if you're new, I wouldn't place a trade yet. And because with the risk graph, you need to understand how the volatility works, because the risk graphs none of them account for what I explained today in the volatility. Let's see, you mentioned the crazy calendar was not your top strategy, so which one is it? It's hard for me to put my finger on. Great to have a basic occasionally. It really reinforces my understanding of each strategy and how they are each related to volatility. My recent and current RFC trades are doing very well. Excellent, Johnny. Johnny, can you give me some examples of what you've put on so I can share with the group? Let's see, did you put on any trades for tomorrow, Monday? I think I showed one that, yes, we are in trade for tomorrow / Monday, and this would be it. This is the one that we put on, and I was only able to put on one single risk-free calendar, and then the market tanked. And so I'm basically, I've got my credit. And so that's the one that I'll just take my $15 profit on this tomorrow, and that's that. Got in late. Could you show your crazy calendar trade at the end so I can put it on tomorrow morning? So CB again, if you're brand new to this, I would caution you against putting on any trades unless you're confident that you understand what it is that that you put on. So let me pull this up real quick. Alrighty. So let's just pull that right over here. So all right, so that's what I put on. Okay, and that one is, let's see here. That one is at a 20-cent credit. Okay, so it's actually 19th and 22nd. When I pull this up like this, that's for whatever reason, I don't know why it does that. So this is entire thing placed at a 20-cent credit, and we're selling 392, buying at 397. That's the calendar, and then the diagonal, and then the 395s are the calendars. And right now I have 3 of them. If you wanted to do 4 of them, you could do that and do it at a even Steven, maybe a credit of 1 or 2 or whatever. Not to get off on a tangent, but how can we buy stock in Trade Partner? There'll actually be a video that comes out. The laws don't actually take into effect until 3/15, so March 15th, and that's when the official launch date will be, and that's when you'll be able to buy it. And you can, you'll see a video, you'll see the process and all of that at that point. So I received the email. Look. Great call. Thanks. You're welcome, Robert. Is it not yet right period for bullish bearish TPO? That's a great question, Constantino. And the answer is we're too close to a volatility collapse if the market moves back up right now. Still can't get the pricing just yet. And you have to be careful of a volatility collapse. If we were to move down much more from here, then that will come back into play. And we will discuss it. So crazy calendars are for transitional, and we're really not quite into the transitional. We're just just slightly moving into the transitional right now. I mean, we're like barely there right now. But it is kind of a weird place to be in SPY because we're one day away from going into low volatility, and we're one day away from going into solid, rock solid transitional volatility. So I tend to focus more on the low volatility because that's what's going to happen to these trades if the market moves back up. Is there a profit line that shows the risk for tomorrow in case of a big move? So you need to be very careful about this. If that, based on that question, I can already tell you need to be very careful before you place on a trade, because if I put on this trade tomorrow, or if this trade gets filled today, and the market shoots up to 384 tomorrow, I absolutely 100% can almost guarantee you that I will be showing an open position loss on the trade. All right, so that is not. You need to, if you're not prepared for that, and you need to see a risk graph to understand that, you probably should hold off on actually placing the trade and watch the spreads. Watch the pricing of the spreads change with the market movement. You'll be far better off in the long run. Do you have a strategy that exports an IV rise before earnings and collapse after earnings? So that has nothing to do with SPY and nothing to do with this call. And the short answer to that is no, I don't target earnings. I do take trades based on an inflated value of the options as you're going towards earnings, but I don't say this is my earnings trade. I don't have a strategy where I say this is my earnings strategy. All right, so somebody took the trade, got filled at 22 cent credit. 397. So I got filled on 4 SPY call spreads at 397 for 10 cents each. I'm waiting for the bounce to get a better price on my diagonal. All right, so we have somebody who went ahead and bought the calendars on a leap of faith at 10 cents that the market's not going to continue moving down, and now he's got a diagonal spread that he's waiting to get an even better price for if the market moves up. That's certainly something you can do. You just have to understand, Robert, that that diagonal spread has a very low probability of making any money unless the market moves up. So it is a directional, definitely a directional trade while you're waiting, but yeah, it's certainly something I've done before because I'm not playing it as a directional. I know you aren't as well. I'm playing it to get a better price on the diagonal, just like you did. I've done that before. You just need to make sure you're not too aggressive on that diagonal, or too conservative, I should say. All right, hello, Ryan. Do you think we're heading to tanking right now? Tough couple of weeks. You know, I don't like making predictions like that. I like preparing. So if we tank, I'm going to be fine, and if we don't, I'm going to be fine. That's the way I like doing it. So I'm not gonna. I don't know. I have no clue whether we're going to tank over the next couple of weeks or not. I can tell you, you know, long term, I know it's coming. Everybody should know it's coming. We've spent way too much money. I mean, they're going to have to print money. You know, physically speaking, we're in an awful position. But I've always said never underestimate the government's ability to kick the can down the road just a little further. All right, when I put on the 397.402, there's only 6 cent credit. Is that right? Probably. I mean, that's going way out there. Yeah, so this is a trade that I put on Monday. This is not available right now. This is a trade that I put on Monday when the market was trading up here around 388, 389. All right, so all right, PDS Trader. Yeah, PDS Trader is going through a data reboot, and that should be hopefully taken care of by tomorrow. I put this on a separate trade. I have put 2 of these on in separate trades. I'm in Germany. I think that's not possible for me. Yeah, so if you go to TRADE-REC, there are some of my foreign clients that absolutely do have brokerage at TRADE-REC. You just have to call them and say, hey, I really need to open a broker, an account here. At times when I profit stack, I sell more premium further than 5 points apart. Is that a no-no? That it's not going to be as good as you think, Lewis. So you do have to be careful of that. If you're in the middle of profit stacking when you do it, though, it's probably not as bad to go a little further out, but you definitely need to make sure that you're not creating a big dead zone and not realizing it. So if you do these Monday and Thursday, 1 p.m., what would someone do if they like most people work these hours? So most of this is informational, and most of the trades can be placed on, you know, the following day, later that afternoon, whatever the case is. So these are really more for learning, and we learn, and we also put in a live trade. It's kind of a sidebar thing because, like I said, it only takes me 2 minutes to put on an order, right? I look at the option scans on Trade Partner or the spread scan on Trade Partner, place the order, and I'm done. I mean, it's not that hard. So most of this is learning stuff, and it's all being recorded. Thank you for a great answer to my question. Great call. Thank you. You are quite welcome, Michael. The analyzed option in TOS never comes up with the same risk graph as what you show. No, because everybody uses different. We use the volatility calculation. It's a variation of Black-Scholes that our data provider uses. However, we are redoing PDS Trader, and it's due out. The initial version is due out on April 30th for testing, and we are using our own calculation. So hopefully, if we've done it right, and I think we have, it'll be much more accurate than what we see. TOS is not accurate either, by the way, in various circumstances. All right, perfect, CB, perfect. Today was a good review of the trading approach. Maybe also do a review of deciding early exit in case of loss. Yeah, we're gonna. That's a great great suggestion. We are going to deal with that. What's the calendar? We're going to deal with that on the 11th. If I sell a single call to pay for calendars, is there a way to hedge the risk? Derek, if you use that strategy, now the probability is that you're going to see a profit before it ever gets to that risk if you've done it right and you've gone far enough out of the money. Other than that, no, you just you have to do a margin hedge, a margin type hedge. You might want to consider, as time goes by, hedging it at that point when the options are cheaper. But other than that, you have to make sure that you go far enough out of the money that the probability of ever realizing a risk on that is like super small, because you'll be going through the profit peak of the calendars. Do you know when the system strategies in PDS trade will be fixed? Yeah, so I just answered that. When as I put on a 246 March buying. Okay, I'm going to copy that. Thanks for providing that, Johnny. Let's see. You have March 18th, March 21st. Yeah, it's March 19th, March 22. When that window pops up, that specific window, for some reason, it puts the date one day before, and that's not us. That's actually the broker. So we're just grabbing that data from the broker. So it's on their end. We've already tried to fix it. And it matters not. It's nothing more than we'll call it a clerical error on their part. My original 246 trade got a 232 credit. Oh, wow, that's a nice, decent credit. What was the broker that charges 13 cents? That would be Trade-REC brokerage. And make sure you mention my name when you contact them. TARDIER. Trade-REC. Would you sell two call? No, I don't make any money from Trade-REC. They don't give me any kickbacks. They don't. I don't receive a penny from them. So. All right, would you sell two calls being more out of the money to get $1 credit? Let's say 50 cents to pay for the calendars. So those calls would be on the right side of the calendar strikes. Derek, that is a great question. So there are times where I try to put the call on the right side. If you're far enough out of the money, then I wouldn't be worried too much about it. But if you're not far enough out of the money, then I would. So you know your situation more than I do. If it were me, I could absolutely do it, because I've been doing this for however long. I know how everything's going to look. I'm not over trading, et cetera, et cetera. All right, Ronald, you will be getting an email if, yeah, you'll be getting an email. Or you can call Spring. And I don't have her number right here. Why don't I have her number right here in front of me? I'll get a number here in just a second. So Michael, so Trade Partner is for if you have a brokerage account with either Tradier or TD Ameritrade right now. Those are the only two brokers we're hooked up to right now. So if you don't have an account there, you want to get an account there, and then you can grab your copy of Trade Partner. And so looks like Spring is on the call, so she gave me her number. So I'm going to post this on here. And so if you want to get started, if you here, let's do this. And all right, so that's Spring's number. Call Spring. Can we request help beta test the new PDS Trader? Absolutely, Terrence. We will actually be reaching out to our users once it is released for testing, and you can absolutely help us test it. We would love that. Let's see. So I'm going to give y'all, this is the second question on that. I'm going to give y'all a heads up. I'm actually doing a webinar early next week for how you can get lifetime Trade Partner, lifetime version of Trade Partner. So you'll never have to pay another penny for it. No upgrade fee. This will be the last time that we offer it ever at this price. I've done it once or twice in the past, and this will be the last time we ever offer a lifetime, and it will be $9.97, and that's it. And you'll never have to pay another fee for Trade Partner. So that's coming out actually on Monday or Tuesday. If you want to go ahead and grab that, you can call Spring, and she'll go ahead and give you that deal. Let's see. When your 3 to 5 legs expire, do you close the 8 legs at the close tomorrow, or your risk-free call? Michael, so generally I close everything at the same time. However, if the long legs are worthless, then I'll hold on to them. Every now and again, not often, but every now and again, you'll hold on to the long leg that was worthless. Market screams to the upside on Monday, and all of a sudden you've got extra profit. And you get out immediately, by the way, when that happens. You get out on the surge to the upside. So I will hold on to the longs. Otherwise, I get out at the same time. If there's any value in the longs, I get out because that's part of the profit potential of the trade. I forgot to answer my question about the trade you mentioned on email you sent. Shoot, Nuno, I I hate to tell you this, but I forgot what trade you're talking about. I apologize if you can remind me on that. Great review today. Once TP is fully hooked up to multiple brokers, will we be able to switch accounts with one TP or need to load multiple versions? So we've looked into that, John, and as of right now, it's better off to keep them separate because they're doing different APIs. They're accessing different APIs, different nuances, and the work that would be the law of diminishing returns applies here. The work that would be required to be able to toggle from one broker to another broker in the same Trade Partner platform is difficult. It's a lot, and we've just got so many other things that we're wanting to do. All right, Scott, thanks for posting that number. Yeah, too slow. Never mind. Any plans to connect trade partner to Tastyworks? So we have looked into them, and the first response is not yet, but it is a possibility. Now that they've been bought, it is most certainly a possibility that we could do that through IG. Will trade partner become its own broker? So, most likely not. That is certainly on the table, but it's not one that has a higher probability. So when you buy, for example, if you are looking to buy stock in trade partner, it's most likely that we're not going to go the broker route, but it's not an absolute impossibility. Okay, we're probably 2 or 3 years from even possibly hitting that point, and making a more determined decision on that. All right. Oh, thanks, Nuno. I appreciate that. All right. Looks like I got all of the questions. So again, here I should have put this on the calendar date, but I'll just tell you what we are going to be discussing on Monday is the risk-free calendar core trades, which this is really actually, excuse me, pretty good market action for that particular strategy. And so we'll spend most of the day on that on Monday. All right. I hope you enjoyed this call. I hope to see you again on Monday. Everyone have a wonderful afternoon and weekend.